And higher prices for housing, food, and other everyday items are leading to new concerns about inflation. So let's get some analysis on what all of this means for our economy. Joining me now is Mark Vitner. He is a managing director and senior economist for Wells Fargo Corporate and Investment Bank, and he's responsible for tracking U.S. and regional economic trends. Welcome to BNC, Mark.
Great to be with you.
Thank you so much. Well, let's start with housing. Inventory is low, prices are high. How long do you think this seller's market will continue?
Well, I think it's going to continue for quite some time. The inventories of homes are at record lows right now, and we've seen a real fundamental shift toward home ownership, where because of the pandemic, people are finding that they need more space. And so we've seen a shift away from multifamily housing, either rentals or condos, toward more single-family ownership. And so folks are moving increasingly into the suburbs. They want a little bit more space. And we haven't been building a whole lot of homes in recent years, so there's just not a whole lot of inventory to choose from.
Now, what about food prices? They're also higher. We know that many consumer goods will see price hikes this year. So how concerned should people be about inflation?
Well, inflation is coming back. I mean, there's really no doubt about it. The Federal Reserve has said repeatedly that they think that the rise in inflation will be temporary. And I think what we're seeing is something that's a little more abrupt than the Fed was expecting. And I'm afraid that those inflationary pressures might be a little longer lasting.
All right, so let's talk now about cryptocurrencies. For years, they were considered fringe investments on Wall Street, but we saw this week, Bitcoin plunge, and we also saw the stock market plunge as well. It also dropped. There was some sort of correlation there. Will these cryptocurrencies eventually be accepted by mainstream banks?
Well, I'm not quite sure what it's going to take for that to happen. I do think that the cryptocurrencies do have a place. They're a speculative instrument primarily right now, and they're not used for transactions, so they're not a replacement for money. They're more of a replacement for gold, and that's easier to hold than gold because you can hold it electronically. What happened this past week is that we saw China and a couple of other governments hint that they would put some restrictions in place on cryptocurrencies. And that might take away some of the secrecy, which had made them attractive to begin with. And that's why we saw the values come off a little bit. In cryptocurrencies, a lot of folks that have been trading them and owning them, they're highly levered. And so when the prices fell, they had to sell something else to cover their short positions. And that's why it bled over into the stock market.
So when you talk about investing, because we are in an economy right now that is certainly in influx, there's a lot going on because of COVID-19 and other factors. You know, people can't do what they traditionally did, put money in their 401k or rely on their stocks because there's so much volatility. What type of things should people be looking out for now in terms of post-COVID? I mean, investing looks different, saving for the future, whether it's trying to afford a home, whether it's trying to save for retirement. There's so many different things, of course, people are trying to use their resources for. So what should people be looking to do? What kind of options are there now that COVID is kind of a little bit going away? I won't say fully, but it seems to be much more under control than a year ago when it started. What are your thoughts on what direction people should be looking toward as we leave this era of COVID crisis?
Well, the threat from COVID is diminishing. I think that's the way that we should be looking at it. It's still there, but it's diminishing. Clearly, we're seeing fewer cases. And as the threat of COVID diminishes, the economy is returning more back toward normal. It's not going to go back to where it was previously, but we're going to see something that's approaching a more normal level of economic activity. In terms of what people should do, they should try to think of their investing horizon over the long run. They shouldn't try to catch the next big thing or fear that they're going to miss the next big thing. They should really be investing over the long run. And that's really what, when you think about 401ks, that's really at the heart of the whole concept of 401ks, is that you save a little bit over time, and so you average in the good times and the bad times, and over the long run, that typically proves to be a winning strategy. So I think that as we move past COVID, folks need to think about what a return to normal is likely to look like in their business and in their lives. And along with that, as folks are returning to the workforce, we're seeing that employment growth has picked up across much of the country. That businesses right now, if you look at job postings around the country, they're significantly higher today than they were pre-pandemic. So we're getting to the point now that people can begin to look past the pandemic, and my advice is to try to think it long and hard about where you see your particular situation in life headed, and think about the long run. Don't try to pick up every next big thing, because they seem to come around a lot more frequent than you would think.
And Mark, your final question, with your expertise at Wells Fargo Bank, do you think that we'll come out of this in 3 years, 5 years, 10 years? I know it's hard to predict. The markets go in cycles. Certainly you've seen many cycles come and go. What are your thoughts on how long this cycle will last?
Well, you would be surprised at how quickly we're coming out of this. The GDP growth in the current quarter is going to be close to 10%. And in terms of the output of goods and services, we will have completely recovered by this summer. Employment is taking longer to recover, and we probably won't get to our pre-pandemic level of employment until about this time next year, probably spring of next year. So from an output standpoint, we're getting there fairly quickly. And I think that 3 years from now, there seems to be a debate as to whether we're headed for another roaring 20s like we saw after the Spanish flu pandemic ended. And I'm not so sure that we're going to see that. For starters, the Federal Reserve and the federal government have put a lot of stimulus in place, and so we are likely to come out of this with a very strong economy initially, and that's what we're seeing right now with 10% GDP growth. But I think that strength is going to diminish fairly quickly when we get toward the end of next year, the end of 2022 and 2023, and that we'll return to what we saw pre-pandemic, where growth was much more modest, somewhere in the 2 to 2.5% range from year to year.
Interesting. All right, we're out of time, but thank you so much for your analysis and perspective. We appreciate you joining us here. Mark Vitner from Wells Fargo. Take care. And we'll have more of BNC Live when we return, including a sneak peek at the world tonight. Stay with us.